So let's look at an example here, and you guys have already seen this, and you've already worked some examples of WACC in exactly this way. I just broke it apart. I took the formula and I broke like every individual step apart into this table so that we can see exactly what the contributions are to the weighted average cost of capital one by one. Certainly this isn't something you have to do in the long run. You can type that whole formula out into one cell in Excel and condense all of this down. But it can be helpful to look at all the pieces and make sure that you understand where they're all coming from. Okay? So we'll jump back to UPS. That's what we've been doing so far throughout the class. Weighted average cost of capital for UPS, and I think this was 2013 data, so about 8%. And we know that that's coming from two sources of capital, primarily from debt and equity. So what we want to do first is look at the market value of debt divided by the market value of the firm. That's the proportion of total capital column here. And for debt, that's 15%. So 15% of UPS's capital that they've used, remember you're using capital to buy assets, to make investments, to do whatever. 15% of that capital has come from debt. The rest, 85%, has come from equity. Next is cost of capital. We estimate the risk of these two sources of financing. The cost of capital for debt, 4.9%, for equity, 8.9%. This makes total sense. Equity is much riskier than debt. And so we expect to see a cost of equity that's significantly higher than a cost of debt. Then we multiply by the tax rate, but we only do that, of course, for debt because equity doesn't enjoy the equivalent would be a dividend tax shield, I suppose. Equity makes payments to its equity holders, to shareholders, in the form of dividends, in a similar way that debt holders get interest payments, but interest payments are considered a business expense because they are a promise. And so firms must pay the interest. Because of that, they're considered an expense. That's why you get the interest tax shield. Dividends aren't considered a promise. Remember, they come out in the income statement after net income. Net income is split into dividends and retained earnings. So because dividends aren't a promise, they aren't a business expense, you don't enjoy any tax benefit to paying dividends. In fact, dividends give rise to what we call corporate double taxation, where the company pays taxes before it distributes dividends, and then shareholders pay taxes on the dividends they receive. So there's actually a tax disincentive to paying dividends. So the after-tax cost of capital is not any different for equity. It's still 8.9%, but for debt, it's 3.1%. Because at the time, the marginal tax rate for UPS was 37.1. Now obviously, in the past 3 years, after the big tax law change in 2017, the marginal tax rate has dropped significantly for major corporations. And so it's probably 21, 22% for UPS at the time, right now, but at the time it was still 37. So the contributions to the weighted average is just the two parts of the WACC formula split into one. So we can just add those two together to get the total weighted average cost of capital, which is 8%. So what does this mean? This means that on average, the investors for UPS demand a return of 8% on their money. UPS then has to find a way to provide that 8%. Right? Now remember that this is neither individual financing source's actual cost of capital. UPS doesn't pay 8% on its debt, it pays 4.9% on its debt. And equity investors don't demand 8%, they demand 8.9%. This is the average cost of capital across both sources of financing. That means on average, UPS needs to be taking projects that provide an 8% return or greater, or they won't be able to satisfy their investors on both sides of the coin. Right? And that's the important decision making. When we talk about hurdle rates, this is what that means. The hurdle rate for UPS means that the projects that they invest in must provide returns greater than their cost of capital, or they start to lose money. We can think about this in the easiest way by just thinking about a firm that only has debt financing. So imagine that UPS only had debt financing, no equity. They were 100% owned by somebody by the founder, so they don't have any equity financing. Then their cost of capital on debt would be 4.9%. That's their interest rate. The best way to think about this is to say, if a firm took a project that only provided a 4% return, if they had to pay 4.9% interest on the loan, they would be losing money every single dollar that they made, right? Because their interest expense on the money they used to finance the project is less than the money being generated by the project, the return being generated by the project. It works the same way for the broader cost of capital. If UPS is not taking projects that provide greater than 8% return, they are potentially losing money for their investors. Now that we've looked at and talked about the components of WACC, let's go into a little more detail about how we estimate these components, about how we arrive at these numbers, right? Because the difficulty in calculating WACC is certainly not in the formula. This is a pretty straightforward formula. Some multiplication, some division, some addition. Nothing I would expect anybody in this class to have any trouble with. The difficulty, just like with a discounted cash flow model, is in estimating all the parts of these models. So we'll start with equity, then we'll go on to another lecture where we talk about how to do everything with debt. And so when we're talking about equity, we're going to need two things out of equity. First is we're going to need the market value of equity, and second is we're going to need the cost of equity. So let's talk about the cost of equity first. The cost of equity, or the return on equity, is the expected return of the firm's common shares at the time that we're doing the analysis. Okay? Now, the expected return, and the problem with the expected return, or estimating the expected return, is that this is not observable. In other words, the expected return of a stock is what equity investors in UPS demand in terms of UPS stock performance. But how do we know that? Well, we don't. We can observe what used to be true in the past. We can observe what the historical performance, historical return of UPS has been, but that doesn't tell us much about what equity holders expect to happen in the future. Maybe they expect historical returns to go up because they think UPS is going to outperform, or maybe they expect it to go down because they think it's going to underperform. Right? What's important, and the way we get around this, is that those expectations are built on the risk of the firm. In other words, equity investors' expectations about return are built on their expectations about the firm's risk. And we do have some better methodologies to determine the firm's estimated risk. And then from that, we can use some models that translate risk into expected return. So we'll look at three different models that help us do this. The first being the capital asset pricing model, CAPM, something I hope you guys are all familiar with, hopefully from the intro, if not from an intermediate class. And capital asset pricing model is a very simple but very powerful tool. It says that a stock's expected return is primarily driven by the way that it varies with the market's expected return. Okay? So anything that affects the market on average is also going to affect a stock in specific. And each stock is going to have a sensitivity to those market movements and to those market risk factors. And that sensitivity is what's called beta. And beta is going to help us determine the risk that a stock faces, that a firm faces. And then through that, we use the capital asset pricing model to say, okay, given a firm with this level of risk, what should the expected return be for that firm? Right? Again, this is a very powerful tool. It's a very prominent model. It's still widely used in practice, particularly for firms in harder to value industries or in harder to value countries. The capital asset pricing model is still a valuable tool. Okay? This is a Nobel Prize winning tool, so it's something that you still see a lot. The next one is a little newer. It's called the Fama French 3-factor model. And basically the Fama French model and the next model, the arbitrage pricing theory model, they both say that the CAPM is a good way to estimate risk and return, but doesn't do enough to do it, to estimate risk and return. Essentially they say that a stock's return is determined by more than just its sensitivity to market risk, but also to all other kinds of factors. In fact, the arbitrage pricing theory says it could be any number of potential factors, even ones that we don't know. Where the Fama French 3-factor provides some specific other factors, risk factors, that also happen to influence firm expected return and risk. And so we can use one of these three models, and in practice, you're just going to use one of the first two. The arbitrage pricing theory is a really nice mathematical model, but a very hard to implement practical model. So the first two are what anybody uses, and on a first pass, lots of people are going to take the easy way out and just use CAPM. If you need a little more rigor, then you jump into a Fama French 3-factor model or a 4-factor, 5-factor model, right? In practice, the estimation procedures are the same, even though the math gets a little more complex.